Prasanna from ICICI Bank and Jayesh Mehta from Bank of America to take this point exactly forward. Gentlemen, hi, good morning. Great to have you both on ET Now today. Prasanna, if I could start off the discussion with you. I mean, what is the correlation here with bond yields and corporate bonds giving you such high annualized rates?
So I have a kind of a slightly different take on that.
Sure.
So obviously the correlation will be there very strongly with the government bond yields which are trading in India, as well as what's happening in the rest of the globe. And I'm sure that you are aware that a lot of bonds in the global markets are actually being consistently yielding higher and higher. And we are talking about US treasuries as well as UK gilts and German bonds, where all yields have been going up. And this is primarily on account of the fact that the global central banks have been raising rates. So that's point number one, that you see that global bond yields are going up. And in sync with that, Indian treasuries also should be going up. But having said that, I would also make the point that when compared to the kind of up move that we have seen in global bond yields, Indian yields have actually not gone up as much. Just to make a comparison, this calendar year, US yields would have probably gone up by as much as 300 basis points, but Indian 10-year yield has gone up just by around 100 basis points. To some extent, this also, kind of is because of the fact that the Reserve Bank has actually raised 190 basis points of repo rate. But it's also combined with the fact that Indian insurance companies and provident funds and the banking system have picking up such large, long duration bonds. Coming to the corporate bond side that you are talking about, the so-called AAA corporate bonds, which are actually trading at much, much lower, kind of credit spreads in the market. What I think your story is actually referring to is the NBFCs, which obviously always borrow at a slight premium over what's happening to the AAA manufacturing sector. And even those NBFCs actually have been announcing some of these bond issues so that it attracts high net worth individuals. And some of these are actually characterized as market-linked debentures, where the taxation on some of these debentures held by HNIs actually gets converted as capital gains, and if they hold it for more than a year, you actually get the benefit of indexation as well. So all in all, it's a mix of higher global bond yields, higher Indian treasuries, higher, lower liquidity tightness, leading to a higher cost of funds, and combined with this market-linked debentures, which is actually giving the ability for corporates to actually tap the HNI segments, which are looking at superior post-tax returns for their investments.
Jayesh, morning. And that's the other thing that equity market watchers like us always wonder whether this is a trend change here, whether now you forcefully have to have a part of your investment into fixed income, which you could completely skip for the last 2 years and be okay with.
Yeah, so Indians always invested more in fixed income, but till now you had deposits which are always yielding higher than government bond as well as corporate bonds. So therefore, attractiveness for any of the bonds was never there. It's for the first time post 96, 97, for a consistent period, you have deposit rate, which is rightly so lower than government bond, lower than corporate bond. And that's the reason we are seeing not only corporate bonds, even the equity market, basically individuals' investment into financial sector, which was completely monopolized by fixed deposit. So that's changing. And I would say that's good for the financial market and the capital market. Now, of course, people can go on arguing why should bank FD be lower and than the government bonds. The credit rating is much lower than the government bonds and stuff like that. But let's not forget, banking is a service industry, and therefore, rather than competing on fixed rate deposits, they should be competing on service. That's what happens globally. India, it may still take time. Again, we are seeing the deposit is going up. The only worry is once the deposit rate crosses corporate bond level, if it happens, that would kind of slow down the financial instrument investments, both equities and fixed income.
So while that's a different debate altogether, when we talk about the fixed deposit rates versus what's happening on Main Street, that's the pertinent point that we're raising, right? Why should you be having fixed deposits when we're seeing what's happening in the corporate debt market? But Jayesh Mehta, the point also is, if you're going to get retail investors here, has that penetration started to improve? Is there any data that can also back it?
So we are very clearly seeing from the data with mutual funds on equity, which is a financial market product. At the same time, on government bonds as well as state development bonds, there's been a lot of demand by investors in through mutual funds, which is the right way to go. So particularly state development bonds also. In terms of corporate bond, the challenge for mutual funds also and everybody else is we don't have enough issuers, right? As Prasanna said rightly, NBFC is a different segment, but when you say corporate bond, people also like to have manufacturing corporate, AAA corporates as a part of the portfolio. And that's quite visible if you see banking credit also, the corporate credit is not really growing that much. And the same is reflecting on the bond side. The issuance is not really that high. And that's what we'll have to wait and watch as and when the issuance starts coming in. So, broadly speaking, as we say, the CapEx mostly is happening from the government side. As soon as the private CapEx picks up, maybe we'll see both credit demand for corporate as well as corporate bond issuance that may come up largely. So,
How risky is it? If you're going to be talking about it as being a more lucrative and a more attractive asset class also versus FDs, is it more risky? Prasanna, my question was for you. If you're talking today about corporate debt, instead of putting your money in FDs, one should also discuss the other side, which is it more risky?
So I think we are comparing chalk and cheese here. When you're talking about fixed deposits, maybe we are talking about the banking system fixed deposits, which is what Jayesh was referring to. And those yields are, right now gradually inching up because of the liquidity tightness. But still, I think the highest deposit is today in the region of 7 to 7.25. And the bonds that you are referring to, especially the kind of bonds that your story referred to, were non-banking finance companies, which definitely are not of the same credit quality. So I think these are two completely different credit instruments. So any investor, especially at the retail level, if they are looking at investing in these kind of debentures versus a bank fixed deposit, then obviously, they have to be advised that there's a different, from a credit risk perspective, there are two different instruments. And in terms of if you have to compare between the debentures issued by those finance companies and the deposits which they have, they themselves are raising, then I think you can then say that the credit risk is more or less same. And in which case, then the difference could be, are you locking in your money for a 3-year, 5-year period fixed, or are you actually putting in a liquid instrument which will actually give you the ability to, sell it out? So from that perspective, I think the debentures also offer you a lot of advantages, that it gives you liquidity in addition to giving you the yield pickup. And in like I said in the beginning, even the tax advantage that comes along with investing in the MLD kind of debentures always exist. So all in all, so it's a different risk return spectrum that we are really talking about. It's up to each investor to decide what is the spectrum, or what part of the risk return ladder that he's really in, and then accordingly he or she should be taking the view.
Debt turning attractive, looking like it. Thank you so much, gentlemen, for joining us today on the show to put all of this in perspective.